Welcome back to the 45th episode of Coffee with Krav. I'm Mark Kravitz, and this show, I have conversations with different people from different walks of life where we're looking to educate, entertain, and have some fun. Today, we're going to dive into the pulse of the market with someone who always brings clarity to chaos. From micro trends to tactical positions, Jack's insights are a must-hear for anyone navigating today's investment landscape. So grab your coffee or whatever beverage you have, settle in, and let's go. So let me start by reading Jack's bio. Jack Janasiewicz is a lead portfolio strategist and portfolio manager at Natixis Investment Managers. He's responsible for providing insight and an analysis on global economic and capital market themes and their impact on portfolio construction and asset allocation. He has over 25 years of investment experience. A recognized expert in macroeconomics and market trends, Jack regularly shares his insight through top financial media. His analysis has been featured on multiple publications, including Bloomberg, Reuters, Wall Street Journal, Financial Times, and he appears monthly on Bloomberg TV, CNBC, Fox News, Reuters TV, and Schwab Network, and of course, on Coffee with Krav. This is actually his third time on Coffee with Krav, and he's been a terrific, there you go, cheers. He's been a terrific friend of the show, so welcome to the show, Jack. We really appreciate it.
Yeah, great to be back, Mark. Thanks.
So this has been some year in the market. It was positive going in. Tariff craze caused the markets to drop over 20%, only to see a reversal as the tariff craze took a backseat to the bombing in Iran. And then we had a few more extensions on the tariffs, and there's deals with countries. And now we have pretty good earnings season. So let's go backwards, reflect on the markets, how we got where we are, and then we'll take a look at the future. So just a quick reflection on your perception of the market.
Yeah, and I think this actually brings up a pretty good point here where, as from an investor's perspective, right, you certainly have split this backdrop into two different cycles, right? You have the short-term prospects and the longer-term prospects. And, a lot of the things you just sort of listed off, a lot of those were geopolitical headlines that hit and certainly impacted the market short-term. And then the longer-term prospects, some of the stuff really didn't have a massive impact on the longer-term fundamentals of the U.S. economy. And by default, really the earnings backdrop for U.S. corporate America, if you will. And as a result, those sort of ebbs and flows along the way can sometimes mask the longer term trajectory. And again, here we are today at all-time highs. So again, I think from an investor perspective, it's sort of like, yeah, there's going to be blips along the way. Those tend to be short term. The long-term trajectory tends to be up. And so let's not get caught in a lot of these sort of headline knee-jerk reactions. Let's focus on the big-term fundamental backdrop, which has still been pretty strong, obviously. And here we are sitting close to all-time highs again.
All right, so let's start with the tariffs. Just going to take a little bit of perspective. Have the tariffs been positive? We have the lowest trade deficit since September 23 in July. The European deal alone will bring in $300 billion of extra tariff money. They committed $600 billion to the U.S. of investing, another $750 billion in U.S. energy that they're going to buy. That's over $1.6 trillion. So, I look at it and say, all right, well, that seems really positive. I mean, the counter question is, do you see tariffs as a tax on consumption? And if that's true, then does that add to inflationary pressure? So long-winded question, but you get the sense. What's your thoughts on tariffs?
Yeah, and I think there's quite a bit to unpack there, but I think the bigger takeaway is that there are some positives and there's some negatives, right? You listed the positives. We're bringing in incremental revenue, which helps to offset the fiscal deficit. So that's the net positive. Some of these trade deficits, in some cases, they can be good. They can be bad, depending on what we're talking about. So you see a little bit of the rebalance there. But at the same time, we also do see some of those inflationary pressures being passed on to consumers. Now, what was interesting, we just got through second quarter earnings, and we spent a lot of time trying to figure out what our corporates seeing with regard to the tariffs. And when we look at the inflation data, we do see pockets of prices starting to slowly tick a little bit higher in here. So again, reflective of some of that tariff cost being passed along to the consumer. But at the same time, going back to the earnings backdrop, we're also hearing some of that burden sharing, if you will. Some of it is being eaten by corporates. And again, remember, those margins that we talk about, they're at all-time highs coming into this year. And so from the perspective of the corporate eating some of those costs, so to speak, when you have margins at all-time highs, they have room to absorb some of those costs. And I just looked last night, estimates for net margins for the S&P 500 are actually hit all-time highs yesterday. And so that's even after digesting a lot of the news that we've seen and heard from corporates, as well as the announcements on the tariff front. So, all in all, some of it's being passed on to consumers in the form of higher prices. Some of it's being eaten by corporate America. And some of it's also being eaten by the exporter side. So, you hear these headline numbers, they sound maybe awful, but I think when you start to peel back the layers, maybe not so bad. And there are pockets of good news that you can parse out of this. And listen, we've been in this scenario now since April 2nd. We got the announcements. Here we are heading into August. I think if we had problems with the tariffs, the market would have sniffed them out by now. And I think what we're seeing is that maybe it's not as bad as maybe we had expected back on April 2nd. And as I like to say, corporate America is pretty good, right? Give them the rules to the game, they'll figure out how to make money. And I think that's kind of what we're seeing right now.
So it sounds like we're having a sharing of it.
Yep.
It's not going all to the consumer. It's not picked up by the country. It's not picked up by just the companies. It's being shared there. So if we take a look at inflation, do you think that we've reached peak inflation? I know the Fed is obsessed over a 2% inflation number. Do you think they'll be flexible with that number, 2.5, 3? What's your thoughts on that?
Yeah, and so this is a very key point, I think, and it's worth kind of digging into a little bit of the detail on the back of, because I think when people think about inflation and tariffs, it's sort of a one-track mindset, right? But when you actually look at how the market and economists view inflation, it's a basket of goods and services. And so when you think about the goods basket within what we call core PCE or core CPI, the two inflation metrics that the market pays attention to, that goods basket is roughly about 25% of the total basket. So when you start to think about tariffs, right, you don't tariff services, you're going to be tariffing goods.
Right.
That's just 25% of the inflation basket. What's interesting is when you look at the shelter component of the inflation basket, and shelter, that's going to be basically apartment rents. The Fed has certain definitions, the BLS has definitions to why they do these different line items, if you will, but that's roughly about 18%. And when you look at real-time pricing for rents, they're actually going down. And why I bring this up, the pass-through from rents to the actual CPI basket numbers that we follow, it lags by about 3 or 4 quarters. And so we see this disinflationary impulse passing through from shelter and rents that will still manifest in the inflation basket. So now you're talking about 24, 25% being potentially impacted by tariffs, but you've got 18 or 19% that's actually going to be going down. Put these together, you're kind of going nowhere. So that's, I think, an important point, because I know when we speak to our clients, a lot of them just say, what about tariffs? Well, again, tariffs are a piece of that basket, but there's other things in that basket that are actually going in the opposite direction. And that's why you may not see the number reflected in inflation as much as maybe some people would expect. And that's, I think, a key thing to think about.
Yeah, thank you. That illuminates things. And so, we're starting to see some numbers that are coming in, economically a little bit shy. So I want to bring up interest rates because obviously that's on everyone's mind as well. And that's tied to the inflation picture. Consensus right now is that Fed is going to lower rates in September. Of course, if there's a change in the Fed, that might be expedited. But just wanted to get your thoughts. Is this a one and done? Is there going to be a series of lowering? Are we even going to go? I saw this morning on CNBC, there was one economist said that it's not going to be till next year. So just wanted to get your thoughts on
Yeah,
interest
I
rate.
think the market is now pricing in, I think, one cut for the last three meetings. So that's September, November, December, if I'm correct. So three cuts of 25 before the end of the year. That's been our base case for quite some time now.
Yeah,
And I think what we'll probably start to see over the next couple of months, the Fed has a dual mandate, right? It's price stability and full employment. They're
right.
spending a little bit more time, I think, focusing on price stability right now. We're starting to see signs that the full employment side of the mandate is deteriorating. And so that balance of risks where they're trying to manage both of those might shift a little bit away from price stability to the labor side of the mandate. And if you really look at just that side of the equation, that really should set up for a dovish pivot in here. And you've had Bowman and Waller, who I think have been on the tape saying that they voted for a cut this past meeting.
Right.
And I think you had Mary Daly, who was just out the other day saying, probably time for a cut. So you're starting to see the ground set, the table set for the potential for that, upcoming September meeting where you get the pivot and you start to see the rate cuts coming through. So that's our base case. We think we start to see cuts, and we think it's going to be a couple of series of cuts going forward.
Okay, good. Thank you. And I'm not sure if this question is too early to ask, but how will the midterm elections affect the market, positive or negative, or not at all?
Yeah, and I think just by if you just look at history, right, you always have a turnover in Congress. So, I think a lot of the policies that need to get pushed through probably need to happen before those midterm elections, because once you get past that, you're probably going to be looking more at gridlock again. So,
Mm.
and that's just, it's not a political statement. That's the way history goes. So, I think if you're going to have any sort of changes done, it's going to have to be front loaded. And we're seeing a lot of that happening right now. Once you get closer to those elections, things are just going to sort of grind to a halt, and you're not going to have much more on the policy front, at least on the fiscal side anyway.
Well, yeah. Also, you talk about history, looking at the 4-year presidential cycle. Year one's usually pretty good. Year two usually has a huge pullback. Year three, we go back up, and then year
Right.
four is pretty good. Do you think that because we already went down 20% this year, that big pullback was sped up this year? Do you think that the Trump presidency makes a difference in this, or will the 4-year presidential cycle, play out again, and at some point in time
Yeah.
next year, we'll have a big loss.
Pretty good track record for the presidential cycle. So it's certainly something that we pay attention to. I
Mhm.
think if I maybe sort of try to map the economic backdrop to that, I think you could probably see our call is maybe for the next month or two, we get a little bit of sideways chop in the markets. Then we get to that September backdrop where we just talked about the interest rates potentially starting to be cut. I think that then probably puts a floor under the market and gives us a catalyst into the end of the year. Flip to the beginning of next year, a lot of the changes that we've seen in the tax code, where you're writing off, for example, no taxes on tips, that's going to be rebated. So you need to file your taxes to get the rebate on that. Again, so you start to get people filing January, February, March. They get those rebates. That might give a marginal boost to the consumer at the beginning of next year. So that might support the market in the first quarter. And then I think things will slowly start to maybe slow down a bit. And so matching the presidential cycles you just talked about to the potential of what we're seeing in the economy, certainly could see us maybe having a good fourth quarter and beginning of the first quarter, and then maybe we come back down a little bit. So to an extent, it's a little bit of just timing on a quarterly basis as opposed to an annual basis that we're talking about there.
Okay. All right, good. And not much keeps me up at night, but if there's anything that does keep me up at night, it would be our debt. Obviously we have a huge debt overhang. The administration, are they really addressing it? I don't know. Do you think that we can grow out of it? Or, is this another kicking the can down the road, and then all of a sudden the can's going to kick back in our face and it's going to hurt?
It's probably a little of both, right? I mean, I think it really becomes a very political ticking time bomb to address that. And so it becomes very, very difficult. But I think the solution for this is certainly to grow your way out of it, right? Because what if you think about the alternative, right? You can either grow your way out of it, or we can go into austerity, right? And if we go into austerity, that's probably going to lead to an economic slowing, which ultimately leads us into a recession. So that's probably the outcome you don't want, right? So just from a perspective of, do you want to continue to grow the economy, or are we going to try to potentially slow it down to balance the deficit? The options there certainly lend to, let's try to increase growth at a faster pace than increasing the spending, and that's how we sort of get that debt to GDP level back down into something that's more manageable. So, from that perspective, it really comes down to productive investments. And I think that's going to be the key going forward here. Let's see if we can make some productive investments, increase productivity. A lot of that can be done through maybe improved infrastructure, and just get that growth rate back up. And you kind of really do, in the optimistic scenario, grow your way out of that deficit. And I think this is the problem that we've seen in Europe, right? Europe tends to rely on the fiscal austerity side of the equation. And so, look at the growth rate differentials here, right? We've always had a far superior growth backdrop than Europe. And that's partly because the different paths we take to get to that end solution.
Turning over to the market for a second, the Magnificent Seven has underperformed year to date. Are we finally getting a spreading out of the market, a little bit more normalcy in the market? Because those Magnificent Seven has dominated the S&P and dominated the market. So what's your thoughts on that?
Yeah, it's funny. I was just working on some stuff yesterday to today on that. Maybe we recall rename the Mag 7, the Mag 4, maybe for the Fantastic Four, because I think you're certainly seeing a shift. But the interesting data point, when I look at what we call the hyperscalers, right? They're the ones who are on the forefront of this AI CapEx spend. Based on the numbers that I have through last week, you're talking about an aggregate CapEx spend roughly at about $400 billion for those 5 names. If I compare that to the contribution to GDP growth, that CapEx spend on AI actually was greater than consumption's contribution to GDP in the second quarter. So that is how important this AI CapEx spend is to the global or to the U.S. economy's growth prospects. And so we spent a lot of time focusing on, listening to what companies said during the second quarter. And are we seeing any signs of that CapEx AI spend slowing? We're not. So it's still all systems go on that front, which is a good thing, because you could argue that AI spend is maybe the single growth pillar right now for the U.S. economy. And so, are we seeing a broadening out? If you start to look at really underneath the surface, the earnings growth there, it's sort of been going sideways for, let's call it the S&P 490, whereas the S&P top 10, those are the ones that are really driving that growth backdrop from an earnings perspective. So you're going to hear a lot about narrowing of breadth. It's really coming still down to, in our point, to a CapEx/tech trade. And I think that's where you probably want to be looking at least over till the end of the year, where we're going to continue to see this growth continuing. And I think it's really going to remain being tech-led. And that a bunch of that does lend itself to maybe 3 or 4 of those large cap tech names still being in the driver's seat.
Hey, let's stay with the tech or AI theme, right? So a lot of things, at least I read or hear, is that in order to grow a way out, a lot of it is going to be based on AI, right? And it's not just the classic companies like you mentioned, but it's other companies, boring companies like Caterpillar that is using AI, and all these other companies that are using AI to accelerate their earnings. Wanted to get your take on the theme of AI, where the opportunities are in AI, and if it is in the tech stocks, great, or has that branched out to other companies as well?
Yeah, and I think you're going to see this sort of cycle where you're seeing a lot of the data centers being the key beneficiaries, and obviously we all know the chip story that goes along with that. And then you've heard, the first derivative of that is supplying energy. You got to have the electricity there. You need to cool a lot of these things. So you've seen the derivative of potential for nuclear and that kind of stuff. I think really that the next wave then morphs into agentic AI, right? It's use cases. It's stuff where I want apps on my phone that will help me uh, use a lot of this AI to benefit myself. And so, I think you're just going to continue to see the flow moving on down the chain, so to speak. And it's going to be the next iteration of that. If I was smart enough to know all this, obviously I would have all my money there and hopefully be retired already at this point. But I just think you're going to continue to see the AI theme playing. It's just going to continue to morph into a different part of the market because there's a new way to start to take advantage of that. So going forward, I still think it's going to be use cases for people, people like you and me. Show me where I can benefit my life. And maybe it's the glasses, that sort of thing. You're hearing a lot of these. You walk into the room, you're wearing these glasses, you can scan the room, and someone's name is going to pop up every time you look at them. That sort of thing. That's use case stuff, and I think that's where you're going to start to see a lot of this sort of moving into for the AI theme going forward.
Yeah, there was something I read about glasses for blind people that the glasses talk to them about what they would be seeing. So that's an amazing use case.
Yeah, and I think
Yeah.
some of the key beneficiaries are certainly going to be in the biotech area, right? Because
Mm.
just the amount of data that they're trying to sift through on a daily basis. You start using AI to help them comb through this, and I think that's a game changer for a lot of that. So that's one of the bigger areas we could see, that sort of spread to with massive beneficiaries. Yeah, valuations are a tough one. They become obvious in hindsight, but in the midst of it, you just don't know how far things can go. And so, I tend to follow the valuation story more as a sentiment barometer, right? Why is something expensive? Well, it's because we all have the risk appetite to want to pile into whatever that stock is. And as a result, that's what's pushing it higher. Why does something have a low valuation? Well, nobody wants to own it. There's no risk appetite to own that. And that's why it's trading at a discount. So I think the trick there is that when you're trying to assign those valuation multiples, whether it be just the market or an individual stock, it's kind of the beauty contest thing, right? You're trying to guess, well, you think it's pretty, maybe I don't. And we're trying to compete against each other to figure out what everybody else thinks it is. And so that's the same thing with a multiple on a stock, for example. You might think 22 is expensive. I may say, hey, I want to own the tech. I want to own AI plays. I want to have cash flow that's, usually positive and fat margins, whatever the characteristics may be. So I'm willing to pay 30 times. So again, we go back and forth, and that's why it becomes a very challenging metric. And it's when we start to get those corrections finally, well, then it's obvious in hindsight. But the flip side is you may have been calling for that for 2, 3, 4 years and missed a good chunk of that run. So that gets tricky. And again, I think it's I look at it as more of a sentiment tool. And again, do you want to buy into something that's got improving sentiment? That's momentum trading, but some people don't like momentum trading. So I kind of go back and forth on that.
Well, speaking of looking good or looking pretty, the international stocks are looking quite pretty. It's their time in the sun. They're outperforming our markets here. Is this a one-year phenomenon, or can this be a multi-year catch-up because their valuations are much lower than our valuations?
I think what happened, if you just think about the markets, let's say go back over the last 3 or 4 years, right? It's been, again, a tech-dominated market cycle, and that's not just here in the U.S., it's global. So it's not surprising that we've seen U.S. markets outperform over that 4 or 5 year period relative to the rest of the world. Now I'll introduce the tariff concerns, the America First policy. A lot of international investors, foreign investors were worried about how they would be treated, how their capital would be treated here in the United States. So they basically took their money and went home. But what's interesting, I think what you potentially probably saw was you've just sort of maybe drifted a little bit higher than maybe your target weight, so to speak, because the U.S. market has done so well. So
Right.
I think you had some repatriation that maybe just brought everybody back to where they probably should have been at the start of this bull market run. So when we look at a lot of the flow data that we get, and a lot of that comes from the Fed and the Treasury Department. In April we saw money being brought back home, if you will. But since then, May, June, July, those data points don't show that. They're basically seeing that money coming back in, or at least increased, if you will, for both the bond market and the equity market. And I think, listen, investors want to put their money where they're going to get return. And where do you see the potential for strong growth? US. What's at the forefront of growth? Tech. Where is all that tech? It's here in the United States. One of the jokes I always, when I public speak, I always ask, can you name 5 tech companies in Europe? Usually we get 2 or 3 guys that know the answer, but we never get to 5. Can you name, $5 trillion market cap companies in the US? Well, you get the point, right? So I think, we're going to have fits and starts where Europe will outperform. But I think, again, looking at that longer term trajectory, I still think you want to be favoring US because of that tech backdrop. I think that's where you're going to continue to still see the earnings growth going forward.
Any thoughts on emerging markets as well?
So, yeah, that's interesting, because if you look at the next iteration of the potential for that tech trade, you do have some tech names coming out of out of EM, and specifically China. So, maybe that does make a little bit of sense. In some of the portfolios that I manage here, we have a small overweight to emerging, and that's largely because we've added to our China piece as a quasi tech play in there. So again, just playing on that sort of where's the growth coming from, it really does, I think, still stick with the tech side, and at least EM has some tech names in there. The other one I would say too is if we start to get the Fed cutting, that probably means that a lot of these emerging market central banks will be able to cut aggressively as well. And, that probably puts a little bit of downward pressure on rates, which probably helps their currencies, which is another kicker for the backdrop. And the growth story is still decent in the EM. So maybe not a bad place to be for maybe for the near term anyway.
Okay. Moving over to gold. Gold has had a great year. It's up almost 28%,
Yep.
but it's been sideways since April.
Yep.
Any thoughts on gold?
So the gold trade, I think, is kind of interesting because I think it really comes down to supply and demand. Now, that's the obvious statement there, but I think a lot of people, a lot of the people that have been in the markets for a longer time, well, it's an inflation hedge. It's a hedge against potential concerns about the dollar. That stuff comes and goes. If you actually, look at that from a historical basis, like I said, it comes and goes. But I think the key here is because we've used sanctions on dollar-based assets as a sort of geopolitical tool, that's changed the demand structure, right? So you're going to have Russia, you're going to have China, you're going to have Iran trying to get away from dollar-based assets, because if they get sanctioned, that gets tied up and they can't touch it. So they're trying to move away from the dollar. And in some cases, the next best thing is gold. And so if you look at a lot of those central bank holdings there, you've seen it going up. So I think the rally that we've seen in gold has largely been a function of trying to move away from dollar-based assets because of what we've seen in terms of those sanctions going forward. So it's not surprising. And my gut says it probably continues because you're going to continue to see that diversification away. The only alternative to that would be a lot of the cryptocurrencies. And so, maybe you have this idea where you kind of are going back and forth between something like Bitcoin and gold. But, I think the story there is really trying to avoid the potential of weaponization of the dollar. And so a lot of these sort of rogue countries are trying to get away from that. And that's why you've seen the performance in gold.
And in talking about that, thoughts on stablecoin? You think that that's going to help this country?
It's certainly going to potentially put a bid for treasuries in there, because you're going to be
Yeah.
backing a lot of those stable coins with a risk-free asset.
Right.
That's going to help certainly with the treasury market demand. So, yeah.
Okay. You brought up energy earlier. Energy this year has been quite a bit of an underperformance.
Yep.
Outside of today, do you see that there's going to be a big turnaround there, or do you think it'll continue to underperform for the year?
Yeah, I think there's room for maybe some technical moves there. And technicals, when I say that, it's just positioning in the marketplace. So when positioning has to shift, things happen in there. But I don't see energy running away to the upside, so to speak. So I think you're probably going to be somewhat in a range-bound market. If you look back at the bombing of Iran, and even with a lot of the Middle East turmoil, I thought we would have seen a stronger move in oil as a result of that. We just didn't get that. And so, I think you could very much make the argument that the oil market is well supplied, or at least it would be expected to be well supplied if something happens. And so that backdrop, I think, makes it probably a range trade at best in here. Yeah, you could maybe tactically move in and out of energy, but to see it run away to the upside, I think you need some more catalysts in there, and I don't really see that right now.
Okay, I'm going to put you on the spot. Surprises or major surprises for this year,
Yep.
and surprises or major surprises for next year.
Ooh, surprise. Let's see. So, one of the things maybe that's not being discussed right now is the potential for a government shutdown as we get to September. And so maybe that's just something to put on sort of the radar. I think there's maybe a greater probability that we do end up going into that shutdown scenario. I don't think it lasts long, but I wouldn't be shocked if that's sort of the trump card that gets played there to sort of increase some of the negotiation and bargaining tools. Nobody's talking about that. Maybe it's still too early, but something to keep on the radar there. And like I said, it's going to be short term. So if you do get any sort of volatility on the market, I would probably certainly be looking to.
You mentioned Trump card. What's the negotiation here? What's the upside of the
Quite honestly just get rid of the debt ceiling. I think that's because it's always the same funny business. It doesn't matter who's in office, the opposition party is going to use that to hold their feet to the fire. And if anything, it just creates unnecessary volatility in the marketplace. I appreciate the idea that maybe you're forcing things to slow down and think about everything that we're doing here. But in the end, I think it just becomes a political tool more than anything and just creates unnecessary volatility and consternation in the markets that, I don't need to see in my 401k, so to speak. So, that's the big one there. I think for next year, it's going to come down to the growth backdrop, right? We were just talking about it yesterday in our investment committee meeting here. What do we see for potential catalysts next year? What would be the key to get growth to reaccelerate? And the big one I think we came up with was residential housing, right? Housing market's been basically in this quagmire because prices have gone up, mortgage rates haven't come down. And what matters most for people really is that monthly mortgage payment. And so if prices are up and borrowing rates are up, that monthly payment is maybe out of reach. And you need rates to come down. You need that 10-year to come down because that's where a lot of the mortgage rates are pegged to. So if we can get rates to come down, I've heard all sorts of stories that the 30-year, give or take around the 5% level, is the key to unlock. That's still a ways away. If we can get mortgage rates to get down there, that could reinvigorate the housing market, and that would be a huge tailwind to the economy. So again, I guess what are we worried about? What are going to be the potential catalyst for increasing growth next year? The wild card, I think, will be rates, and then how that filters its way into the residential housing market, and that could be a big one. But we got to get to that point still.
Yeah, I've read where there's tremendous pent-up demand there. That
Yep.
there's a lot of people that do want to move or first home or they're renting or whatever they're doing, but rates are too high and they're waiting for that to come down. So yeah,
Yep.
that could be a large catalyst. Any negative thing
Yeah,
that
we just sort of talked about the CapEx spend on AI. If that slows and we don't really have anything else to pick up the slack on that, you can kind of see the slowing in potential for earnings growth going forward there too. So that's the big one.
Okay. All right, Jack, this has been another fabulous showing of all your brilliance on the economy and the markets. Any closing thoughts? Anything that you want to leave everybody in the audience with?
Yeah, I know just from our conversations with a lot of our clients, I always sort of say the same thing. The media is trying to sell you stuff, and so they're going to make some splashy headlines. Peel back the layers on a lot of this stuff, and it's usually not quite as bad. And so, listen, things are certainly the headlines make things out to be much worse than they really are. And I think we need to sort of step back and look at the bigger picture stuff here. And it's still pretty good. We don't need to get shaken out of things here.
I'll drink to that. I'll
Go.
drink to that, Jack. Well,
Cheers.
cheers to you. Thanks so much for coming on Coffee with Krav. Thank you, everybody, for another episode of Coffee with Krav. And we will be back soon. Take care and be safe. Take care. Bye-bye.